Hi, everyone. This is Jerry Key from Best Choice Realty. I'm the managing broker here. And today we have with us Kyle Williams. He's the VP and account executive in Washington for IPX 1031. And today he's going to go over some potential changes to real estate in 2021. Welcome to have you, Kyle. Take it away.
Awesome. Thank you, JK. Thank you, Rochelle. Glad to be here. So I can run through this fairly quickly, but I want to make sure that I leave it open to questions, because if I'm going through something too fast, if I'm not explaining something clearly, please jump in and ask questions as you have them. So yeah, I've added a couple slides to this on potential changes. Really the big things right now, the first-time homebuyer tax credit and potential changes to 1031, which I will discuss from a broad overview right now, because we're getting a lot of questions about potential 1031 changes. So I tell agents and brokers, first of all, tax law is outside the scope of your licensing. You take on something when you discuss things outside the scope of your licensing, you take on liability, right? So our job is to work directly with your clients and their CPAs to give them help along the way. Whoops, sorry. Did you guys see the email pop up? No? Okay, awesome. So yeah, so we're gonna work directly with clients and give them any assistance they need. We wanna take that liability off your shoulders and work with the clients or CPAs or attorneys, whoever else is involved. So the most important thing to remember today, call me with questions as you have them. So why discuss 1031s? First and foremost, 1031s are literally the best kept marketing secret in the entire real estate industry. There's a lot of agents and brokers that don't focus on 1031s, but probably should, because they work with investors and they should know 1031s from a broad perspective. There's nothing else like it in the Internal Revenue Code that allows you to build wealth like this. I mean, you can buy and sell assets over the course of your entire life and never pay taxes. Nothing else, 401ks, stocks, Bitcoin, whatever it is, nothing allows you to do that like investment real estate. Unfortunately, it's also one of the most underused section codes as well, just because the majority of agents and brokers don't work with investors or don't ask about 1031 exchanges. So what is a 1031 exchange? A 1031 exchange allows an investor to use all the equity. That's a key phrase I like to use. All the equity, not just the after-tax equity, to reinvest into something bigger and better. They can essentially reposition assets throughout their entire life and never pay any taxes. Don't be confused about the word exchange, because if you're new to real estate or new to 1031s, that word exchange throws a lot of people off. A lot of people think it's like, really, it's a deed swap. You know, you're exchanging properties, right? That's not the case with 1031. Most exchanges are three-party exchanges. I'm an exchanger, I'm one party, I'm selling to a second party and buying from a third party. That's how most 1031 exchanges work. So it's not a true exchange in the sense that we're just trading something. It used to be that way. 1031, we're celebrating the 100-year anniversary of 1031 this year. It was a different section code in 1921 when it started, but it essentially was for like farmers who wanted to like change land and rotate crops, et cetera, et cetera. But this guy is the one who started it, TJ Starker. He's kind of a folklore hero in the 1031 world. Targeting the investor market. So investor clients, less emotional, right? Because even like, I mean, I teach this class, I've done this slide a million times, and even like if I'm buying a primary residence, I'm still emotional. Like everyone, we're all still emotional when it's a primary residence. But when it's an investment property, you know, I've heard of agents and brokers that work with investors that won't even show their clients pictures of the property because it will get them emotionally involved. So they'll just go over, you know, cap rates and stuff like that. Because investors really should just care about bottom line. They shouldn't be emotionally tied to it. 1031 clients are motivated. They have to find something relatively quickly. So it's not going to be the type of client where, you know, you've shown them every property over the last 18 months in King County and nothing ever works for them. Like they, you know, prices are too high and it's unrealistic, right? But with 1031 clients, they have to find something quickly. So it's they either find something in 45 days or they don't. So you know that there's a predetermined set amount of time that they have to find something. And multiple transactions. This is really a cool thing because a lot of agents and brokers will pick up 3-4 sides of business because they're selling one property, but there's a good chance that they're going to be buying quite a few properties as well, more than just one, many times 2 or 3 properties. So not only are you helping clients, you're getting paid to help them as well. Why now? Interest rates. This is a big one. I mean, we've been in a low interest rate environment for a while now, but we're still at like 3%. So a lot of investors that have been waiting on the sideline, I mean, they're gonna snap up what they can now because they know that at some point rates will rise. I mean, rates can't stay this low forever. And granted, this is a whole other discussion about, you know, if the Fed can even raise rates and everything else. But we know historically, interest rates are like real estate. It fluctuates. You know, just like real estate isn't going to go up 15% a year for every year. You know, it's cyclical. But that being said, just like interest rates, you know, we may never see 3% interest rates again in our lifetime. So investors are trying to lock up and have locked up whatever they can with low rates. How can we help investor classes? So if you guys want to do like a condensed version of this class, where we go over some of the 1031 basics and basically open it up to Q&A to like your investors and potential investors, I'm more than happy to do something like that. Just let me know. Feel free to send me an email or give me a call. I'm more than happy to set something like that up. So we look at some 1031 numbers here. 1031 permits the deferral of capital gains. We all know about capital gains. That's what we think of, where we bought the house and where we're selling it at, capital gains. So capital gains is generally taxed at 15 to 20%. Next, we have unrecognized gain due to depreciation. That's the technical terminology. Most people just call it depreciation recapture. That's taxed at 25%. So whatever you've been taking in depreciation, basically writing off on your property for depreciation, whether you took it or not, you're going to be taxed on it. That's taxed at 25%. And now we have the net investment income tax, the affordable healthcare tax of 3.8%. You know, basically on top of both of those. So it's not uncommon for us to see clients pay, you know, close to 25% in taxes as a collective tax rate, but ultimately it's up to their CPA to determine, you know, what exactly the tax rate is. So if we look at this example here, this is a good tangible view of how a 1031 works. Let's say on the left, we're going to sell our duplex in Ballard. We've owned it forever. It's, you know, it's fully depreciated, fully taxable event. But on the left-hand side, we're not going to do a 1031 exchange. We want to find new property, but we want to take our time and, you know, we don't really know much about this 1031 thing. So we'll just pay our taxes and find something else. So we sell for $1 million, we owe $250,000 in taxes, 25%. Leaves us $750,000 to reinvest, and at a 75% LTV, buys us $3 million in new property. That's awesome, but we paid our taxes. On the right, if we just do a 1031 exchange and don't change anything else with the equation and don't pay our taxes, that $3 million turns into $4 million. As you guys know, the difference on $1 million of income, especially depending where you're at in the country, can be astronomical. I mean, $40, $30, $40, $50, $60,000 a year just by doing a 1031 exchange, more in income. So this gives clients a real tangible view of why 1031s are important and what they're getting out of it. So a lot of clients will say, well, Kyle, yeah, at the end of the day, it makes sense, but in a 1031, I'm not really eliminating taxes, I'm deferring taxes, right? And we all know Grandpa said 2 things in life are inevitable, right? Death and taxes? No, only one of those is, because we got the tax thing figured out. Your heirs get a step up in cost basis when you pass. So right now, estate tax laws, federal estate tax laws, super favorable. It's like 11.2 million per spouse. It's not to say that it's going to stay that way forever, but right now you can pass on $11.2 million worth of your stuff to your heirs tax-free at the federal level. Washington State has its own little funky estate tax. It starts a little over 2 million, which I'm not going to get into. But yeah, at the federal level, you can pass on your real estate to your heirs tax-free. That's awesome, right? But at the end of the day, even if you do want to cash out and pay your taxes, you can still get more real estate working for you if you're not paying your taxes right now. And you're actually investing into the economy, helping grow the economy. So 1031 is great for a lot of reasons, but at the end of the day, it's going to help you grow wealth. I tell agents and brokers, you know, don't let your clients cash out of real estate. You know, just help them exchange into something that better hits their financial goals. Because at the end of the day, you know, if they just pay tax, they might be out of real estate, but if they keep investing, one, it's great for them. Two, it helps you guys. And lastly, it's going to build wealth, sometimes even generational wealth if they do everything correctly. So we came up with a phrase a few years ago to make sure people never forget this concept. It's called swap until you drop. Good, right? Yes, I agree. So vacation homes and conversions. This is a cool thing. This is like converting to and from a personal residence. So let's say the most common scenario is someone who has rentals and wants to exchange into their dream home. So this works two different ways. This example is for clients who are converting their primary residence to a rental. So if they own it for the 24 months prior, they rent it out for 14 days a year or less for each of the previous 2 years, and then they use it less than 14 days a year for each of the previous 2 years, they can actually do an exchange on that. So that's a little confusing, but the replacement property is the same as above. So let's not look at the top one, but let's look at the second and third one. So if we look at number 2 and number 3, the taxpayer must rent for 14 days a year or more for each of the 2 years after the exchange. So if you're selling your rentals and exchanging into your dream home, you need to get some rent on it for each of the first 2 years that you own it. And then you need to limit, if you look at number 3 down here, you need to limit your own personal use as well to 14 days a year for each of the 2 years after you exchange into that property. After that, you can move into it and do with it whatever you want. So too long didn't read version is basically your clients are selling, exchanging out of their investment properties, exchanging into their dream home. They just need to rent it out for a couple of years and limit their own personal use. After that, they can move into it and do with it whatever they want. Obviously, they want to make sure they consult with their CPA and they're following guidance, but this is a really, really cool thing. The 121 primary residence exclusion, this is just super important to know. I talk to agents and brokers every day that have never heard of this. Everyone should know about this. This has nothing to do with 1031. This is just for primary residences. So if you live in your primary residence for 2 of the last 5 years, you get $250,000 tax-free if you're single, and $500,000 tax-free if you're married. So as long as you own it 2 of the last 5 years. And what a lot of people don't know is that you can still get a prorated share of that even if you're not there for 2 years. If you can prove a hardship or unforeseen circumstances, which is pretty vague. So divorce, job transfer, medical hardship. So even if you were there, say 1 of the 2 years, so say 1 of the last 5 years and not 2 of the last 5 years, you could still theoretically get 50% of the 250 or 500,000 if there was a legitimate reason that you moved. Obviously, they need to consult with their CPA, but yeah, don't ever tell clients if they only live there for say a year, you're not going to qualify for the primary residence exclusion because they still may qualify for a portion of it. Yeah, at the end of the day, if they're just doing a flip or they just, are timing the market, then yeah, they're not going to get it. But if they needed to move for a legitimate reason, absolutely. Right, potential changes to real estate. A couple of the big ones, and there's been a lot of whispers of like zoning changes as that the federal government will incentivize to change single family zoning to more multifamily. A lot of stuff like that we don't know is going to happen, but the 2 big things right now that everyone's talking about, the first-time homebuyer tax credit. So that would essentially be down payment assistance. That's not really a true tax credit. It's basically just down payment assistance. They would still have to qualify based on credit and debt to income. So just because someone has a 530 credit score and they're weighted down in debt and declared bankruptcy 6 months ago, that doesn't mean they're going to qualify for this. It's people who would qualify, but they just don't have enough saved up. And yeah, a third of people say that their biggest obstacle to buying a home is that they just can't save up enough for a down payment. And it makes sense, especially around here. If it's like, you could have 2 spouses, a husband and wife that are teachers in Bellevue, and together they make, $160,000, $170,000 a year. It's not really enough to buy a house in Bellevue. I mean, you could probably make it work and stretch it out, but really at the end of the day, there's a lot of people that, have good jobs, important jobs that the housing market's gotten out of control for them. And so this would provide down payment assistance for those type of people. So the big question is do we need it right now? I mean, inventory is low. As you guys know, there's nothing on the market, right? I mean, we thought inventory was low a few years ago. It's non-existent now. So should we add more buyers to the pool and drive up prices more and, you know, eliminate whatever inventory there is? I mean, this is a big question. So I don't know what they're going to do. And how likely this comes into play immediately, but this is definitely something that, you know, we think will be put forward at some point. The big question, though, that I get all the time being in 1031s is what's going to happen with 1031s? Are they going to be eliminated? So a senior campaign official declared last year that they're going to roll back unproductive tax cut for high-income real estate investors. That means 1031. And there was a Bloomberg article that got everyone scared about a month ago. That said that they were going to look at 1031s, that it's basically been, you know, a tax shelter for Donald Trumps of the world. And, you know, I wouldn't really agree with that because there's a lot of middle-class families. I mean, yeah, just because Donald Trump, or there's a lot of people in both parties that have done 1031 exchanges, and it's not political because there's a lot of middle-class families of all races, all religions that have built wealth using real estate in 1031s. So just because one person does it doesn't make it bad for everyone. And 1031s definitely contribute to the economy. So it's not a negative net negative for the economy. It's actually a net positive. Ernst & Young did a report in 2015. I know they just updated it too. But as of their last report, as of 6 years ago, they said it would have a negative net impact on GDP of 131 billion over 10 years if they got rid of 1031s. Even if they cap it, that's going to hurt. So at the end of the day, I don't think they'll probably get rid of it. It's definitely a threat. But we would definitely encourage you, you can email your congressperson very easily now. You can just go to their website, fill out a quick email and say, 1031s are important for me and my industry and my clients. Please don't eliminate them. Every little bit helps, especially in Washington state. So like-kind property, another common question that comes up. Like-kind property, Kyle, if I'm selling a rental, does that mean I have to buy another rental? It does not. Actually, all these things held for business or investment use are like-kind. So like in our state, even like water rights and mineral rights, or timber rights, mineral rights anywhere, but water rights and timber rights are exchangeable. Perpetual easements, 30-year leases. I mean, all these things that you would never think about as being like-kind for real estate are like-kind. So clients can sell out a land in exchange into real estate. Marketing 101 tip, solicit and work with landowners. I cannot stress that enough. There are so many landowners in the surrounding area in Western Washington and Eastern Washington, across the West, that own land and have owned land for years, and they have a nice little gain on it. They might have owned it for 30 or 40 years. But if someone ever asks them, hey, are you going to sell this? They're like, oh yeah, why would I do that? I'm just going to pay the taxes, and what else am I going to exchange into? More expensive land? I might as well just hold it. They have no idea that they can actually do a 1031 into something that cash flows for them, because they're not getting income on their land. They're not getting depreciation from it, which is like the #1 tax benefits, even owning investment real estate. They're just sitting on land and hoping for price appreciation. So you can actually help them exchange into something like a duplex, where they actually get rent every month. They actually get the tax write-off of depreciation. So I can't stress that enough. Solicit landowners. Work with your local title and escrow group to get lists for landowners that you can solicit. And you know what? Maybe someone doesn't even want to sell their land, but you're getting a contact. Maybe they're selling a primary residence, or they'll refer you to someone who's selling. So it's just a good way to stay in front of people. There's a lot of agents and brokers right now new to the business that are looking to stand out and grow their business. That's an easy way to do it, is solicit landowners. How you want to do that? Send out a mailer, call them, whatever you want to do. I can't stress that enough. Not a lot of people do that, but people who do that do see gains from it. Eminent domain, basically, if Eminent domain is popping up a lot around here with like light rail, but basically where the government comes in, gives you fair market value and takes your property. You would essentially have 2 or 3 years to find a new property, but like kind means like kind. But it's not 1031. That's what's important to know. But yeah, if you have a property taken through eminent domain, even like condemnation, you'd want to work with your CPA because it's all self-reporting. What is not like kind? Essentially everything else. Big thing being like personal use properties, not exchangeable. Inventory dealer properties. This is why like home builders, for example, like say Toll Brothers, they don't do 1031 exchanges because their whole business is buying, essentially buying land, building property and selling it. It's inventory for them. Flips don't qualify as well. So if you have clients that are flippers, and granted it's getting harder to do in this market with tightening margins and rising prices and everything, but if you still work with flippers and they stumble upon 1031 and say, hey, I've been hearing about this 1031 thing, is this something that I should be thinking about doing? No. If they're flippers, then that's their job. If all they do is flip properties, that's their job. They have to pay taxes just like the rest of us. If they have like a little side hustle, if this is just something they do on the weekends and pick up extra income on, then they can qualify. So instead of buying, fix up, and selling, they need to buy, fix up, and hold, get some rents on it. They don't want to flip the property. So the question that comes up is, well, how do they distinguish that from a flip? It really comes down to intent. There's no IRS guidelines on how long someone needs to hold for. Many CPAs will say a year. If you get some rents on a property that shows held for business or investment use and hold for a year, you're probably going to be okay. Ultimately, 2 years to be 100% safe and remove all doubt. So if you hold your property as a rental for a couple of years, you're probably going to be okay. There's nothing to really worry about. Obviously, you want to talk to your CPA, but around here, it's not uncommon for clients to call and say, hey, Kyle, I bought this property, last November, so I've owned it for, 6 months, and I just got an unsolicited offer from a builder who's buying up the city block, and they want to buy me out for, 25% more than what I bought it for last year. I'd be a fool to say no, so can I sell this and do an exchange? They might be able to, because their intent was to hold it long-term for business or investment use. Like they were approached unsolicited by this developer. They already had tenants in there. Their intent was not to flip this property. They've never flipped another property before. There's no like track record there. So I always encourage them, talk to your CPA, and many times the CPA will say, yeah, your intent was not to flip this property. Your intent was to hold it long-term, therefore go forward with an exchange. But ultimately it comes down to the tax advisor. All right, day 0 on the exchange, close of escrow. So that starts the 45 and 180-day clock. You need to open up your 1031 exchange before you close escrow. I can't stress that enough. I get calls all the time where clients are like, Kyle, I want to set up an exchange, da-da-da-da-da. I'll say, where's title and escrow? And they'll say, oh, it closed last Friday. Unfortunately, it's too late to set up an exchange at that point because you have control of funds. Whether you took a check or not, as soon as it closes and records, you have control of funds. So make sure you set up your exchange and your client set up their exchange before they close escrow. I can't stress that enough. From there, they have 45 days to identify a new property to purchase. There are 3 rules of identification. First rule, the 3 property rule. Clients can identify up to 3 properties of any value to purchase. Next, you have the 200% rule. If the 3 property rule doesn't work, if they want to identify more than 3 properties, they would go to this rule, meaning they can identify up to 200% of what they sold for any number of properties. So if they sold for like say 1.1 million, they can identify any number of properties totaling up to 2.2 million. So that might be, $400,000 properties, in Eastern Washington, for example. But that would only be if they want to identify more than 3 properties. Lastly, if they don't want to cap on anything, if they want to be able to identify more than 3 properties and more than 200% of what they sold for, they would go to this last rule. I call it the all or none rule. It's called the 95% exception rule. But if they don't want to cap on anything, if they want to identify 10 properties at 600% of what they sold for, they can do that, but they have to close on 95% of the value identified. Therefore, if they only identify 90% of the value, then there's nothing they can do at that point. The exchange has failed. All right, timeframes, 45 days to identify, 180 days to close. Someone have a question? No? Okay, awesome. So Saturdays, Sundays, legal holidays, it doesn't matter. Nothing extends to 45 or 180 days outside of federally declared disasters. So this is not going to be, just something small. These are like Hurricane Katrina, the wildfires in California, big things like that. Basically national news type events. If it's on the national news, there's a good chance it's probably a federally declared disaster. But ultimately, you'll want to talk to your CPA to make sure you're affected by it and would qualify for an extension. But they don't hand out extensions just willy-nilly for anything. It's got to be tied to a federally declared disaster.
Real quick, Kyle, is the coronavirus considered a disaster?
So, kind of. I mean, it definitely was in all our minds because it changed our way of life. But to the IRS, there were brief extensions issued last April, so over a year ago, but they have long expired. So there are no extensions in place right now. Yep. This is a question that pops up all the time. Kyle, do I need a qualified intermediary for my 1031? I'm selling on one property and buying the other property the same day. Can I just direct escrow where to send funds? You cannot do that. You always need a qualified intermediary for 1031 exchanges. This guy tried it about 25 years ago and the IRS ruled against him. So you always need a qualified intermediary for a 1031 exchange. Okay, so basic 1031 rules. Really the first two rules, I tell clients it's super easy. You have your identification guidelines, but you just want to do two things: buy for equal or greater value and reinvest all your proceeds. That's it. That's all you have to do in a 1031 exchange, because then the other rules just fall into place. Rule number 3 confuses a lot of people. And if you look at it, you'll probably be confused. And, it is confusing, but I would say as long as you follow rules 1 and 2, buy for equal or greater value and reinvest your proceeds, everything else just falls into place from a math standpoint. So it's really that simple. Clients are just putting all their money into the next property and buying for equal or greater value. That's it. That's all they have to do in the exchange. Mixed use exchanges, duplex. So let's say that I have that duplex and I live in one half and rent out the other half. The half I live in, I'll take the $250,000 or $500,000 exclusion on, and the half I rent out, I'm going to exchange that value right out. So I can actually do a mixed use exchange where I take my $250,000 or $500,000 and just exchange whatever the portion was held for business or investment use. Typo there. Monster-in-law unit. If you have a monster-in-law unit in back, an ADU, the same thing. If you rent that out, that's exchangeable because that's held for business or investment use. So whatever the value is of that, that's what you would exchange out. And if you have a split use house, like say I have an old Victorian and I live in the 2,000 square foot downstairs and rent out the 1,000 square foot upstairs to a college student, whatever the values of that 1,000 square feet that I've been renting out and taking depreciation on, that's the value that I would exchange out. And then I take the $250,000 or $500,000 on the rest. So why 1031? Among other reasons, moving markets seem to be super popular right now. It seems like everyone is exchanging out of Washington state in terms of investors, and that's perfectly okay because 1031 is federal. So it works between all 50 states. Puerto Rico doesn't count as a state for 1031 purposes. And you can't exchange out of the country, but yeah, you can exchange from California into like North Carolina, for example, or you can exchange from Vermont into Colorado. It doesn't matter. 1031 is federal, so exchange wherever you'd like to. You don't have to stay in your state. Estate plan. So I'm going to skip through this. This gets a little long for this. Reverse exchange. This is definitely a big one that's happening all the time right now. So clients will say, Kyle, I'm going to list this property, but I've already found a new property I like, and I think I can make an aggressive offer on it and get the property. Can I do that before I've even listed and sold my house? Yes. But let's say that they want to close on that purchase first too. Is that okay? Yes. They would do what's called a reverse exchange. So a reverse exchange is when the client closes on the purchase before they close on their sale. Ultimately, they have 45 days to let us know what they intend on selling and 180 days to close on it. But in a normal 1031 exchange, we just hold funds. Super easy to do. But in a reverse exchange, we actually have to take title to that new property and hold title under a single-use LLC for the duration of the exchange. So it's more complicated, it's more expensive, but at the end of the day, it's doable. So if you have clients who want to close on their purchase first, it's definitely possible, but have them reach out to me as early as possible in the process so I can walk them through that. And lastly, one of the important slides to know, DSTs, Delaware Statutory Trust. We see a lot of clients going into DSTs right now. So DSTs are fractional interests in commercial property. Could be a portfolio commercial property, it could be one property, for example. It could be like an Amazon warehouse. But clients who don't want to manage properties anymore because they're sick of the terrible T's, toilets, termites, trash, taxes, whatever. They want to go 100% passive. They would love to own an Amazon warehouse and just collect 4% every year, whatever the cap rate is, and never have to worry about anything. Amazon is their tenant, and Amazon will be, they'll get a check every month. They know that that's money good, and they're okay with that. So DSTs are great for a lot of reasons. You can see right there all the different reasons investors go into DSTs. But trust me, baby boomers own a large chunk of wealth in this country, and baby boomers are retiring every day, and they are sick of managing property. But they own a lot of rentals. They own the majority of rentals in this country. People that you would work with, baby boomers. They do not want to manage properties anymore, and they're going to eventually go into a DST. So it's not you do not get paid when they go into a DST. They have to work with an investment advisor that handles DST. But guess what? If you at least bring the idea up to them and get them thinking, you're going to get a listing you would have never gotten before. Because if you're not talking to them about DSTs, somebody else will be. So if you work with clients, especially older clients, investor clients, and they're not familiar with DSTs, definitely get to know DSTs. Spend, if you spend an hour looking into DSTs, reading a couple websites and getting to know it from a 40,000-foot view, that will be one of the best hours you ever spend in your real estate career for educating yourself. Because there are so many investors right now that are exchanging out of fee simple properties and exchanging into DSTs because they get to go passive. They don't have to worry about tenants not paying rent. They don't have to worry about trash, all this other stuff. They're going to be a 1% owner in a portfolio of like Starbucks and Walgreens and just get a check every month. Like they'll have their own little mutual fund of real estate, if you will. So again, it's nothing that you get paid on, but you get listings you would have never gotten before by just bringing up and having the conversation with them. So definitely direct them back to me, their investment advisor, if they have specific questions, but at least, you can at least put the idea in their head. Hey, there's ways to go passive in high quality real estate. Yeah, you'll want to talk to an investment advisor, but there's definitely ways to do it. At least have the introduction. But like I said, if you guys have questions, let me know. But I would spend, 45 minutes, an hour just looking into DSTs and getting to know them from a 40,000-foot view because brokers who know DSTs, they get a lot of listings, so it can only help you. So as we wrap up here, this is actually one of the most important slides. 1031s are unregulated, completely unregulated, because you guys, escrow, lenders, everyone, investment advisors, like anyone who is connected to real estate is heavily regulated. Not us, not 1031s. It's completely unregulated. And literally billions of dollars have been lost. There's a lot of great exchange companies out there, but there's a lot of ones that aren't, and a lot of ones with minimal protections or no protections at all for client funds. So you want to make sure that at the end of the day, remember, when you refer a client, you are taking on a degree of liability. Because if you refer to a 1031 that loses all their money, they're not going to get any money back from that QI that left the country or wired it to the wrong place because they may not have protections. So they will go after you. So again, you always want to make sure when you refer to someone, what that referral, what they have for protections and insurances for funds. We're the exchange division for Fidelity National Financial. So if you work with like Fidelity, even like Chicago, Ticor, Commonwealth, Alamo, a whole bunch of others, we're actually their exchange division. So we do have the highest level of security in the industry. We have a $100 million fidelity bond, $50 million third-party guarantee, and 30 million of errors and omissions on each account. So no matter what happens, client funds are going to be safe and secure. We hold them in segregated bank accounts. We don't invest them. We don't put them in high yield, treasuries, anything that we would deem as safe. We just put them in segregated bank accounts, boring old bank accounts. But at the end of the day, client funds will be there. So super important to know who you're referring to. And again, at the end of the day, you're not taking on any liability by referring to us. That wraps it up. I have my email there, my phone number. Please write it down. Rochelle and JK can give it to you guys if you guys have any questions. But I definitely wanted to leave it open. I mean, if you guys want to stick around for 20 minutes and ask questions, or 6 hours, whatever you want to do, ask your questions now, because I would enjoy getting to answer them.
And we'll look for some questions. I do have one question. I probably have two questions, but so earlier on in the slide when you were talking about heirs,
About
and
what?
they get the heirs. So your
Heirs,
heirs,
yep.
you pass away, you have heirs, and they get the value of the step-up basis.
Yep.
So what if you are a single person with no family per se, and you're not married?
Yep.
So heirs, does that qualify for somebody that you designate as a beneficiary, or is it truly, does somebody who's single have to go out and get married before they die so that they can pass on?
Yeah, you can actually just call me and assign me into your will, and I'll take care of all of that. So that's fine. But if you don't do that, then yeah, I mean, generally you would assign a beneficiary like in your estate. If nobody does anything, like there's a lot of people that don't have wills or anything, then it would go to this state at that point, I believe.
Which is sad. So if you don't want it to get taken away by the state, you can do a designated beneficiary or somebody in your will.
And everyone should talk to an estate attorney at some point and plan that out, because even if you don't have a family, you can still pass it on to a specific charity and everything like that. So a lot of cool things like that to do.
Perfect. Anybody else have some questions? I do have another one if we don't, but.
Yeah, I have a question for
Kyle.
Kyle.
Unmute your line.
Donald's got a question.
Yeah,
Hey,
hi, Donald.
Kyle. Hey, I spoke with you a couple hours ago. Thanks for taking the call.
Yeah.
On slide, can you go over slide 10 again? I think that was the one about eventually converting it to your personal residence.
Yeah, so the wording here is the revenue code is written as if you're converting a primary to a rental, but for what you're talking about, everything is just flipped around. So like you've been, if you've had rentals for years and you want to convert to a primary residence, like let's say you sell 4 rentals in the area and you want to exchange into your dream home on Lake Sammamish. You can do that. It's just after you exchange into that dream home, you need to get some rents on it for 2 years, limit your own personal use for 2 years. And then after 2 years, you can move into it and do with it whatever you want.
Right at the time you move into it and you've converted it to a personal residence, the taxes that were deferred when you exchanged into it, are those then due when you convert to a personal?
They are not. No. So that's not a taxable event. If you sold it, depending on how long you live there, you could get rid of some of the capital gains. But yeah, a lot of people, especially like retirees now, you could have a 75-year-old guy that was an engineer at Boeing forever, and he owns 4 or 5 rentals in the area. He's going to exchange out of his rentals and buy his dream home on the golf course in Arizona. And when he dies, he's going to pass it on to his heirs tax-free. And he never paid taxes at all. But he grew the economy. He did a lot of great things with his real estate that helped a lot of people along the way. But yeah, I mean, most people will end up cashing out and paying their taxes at some point. It's just theoretically you can go that route and, essentially avoid taxes forever.
Okay, thank you.
Yep.
Anybody else come up with a question?
Kyle, what's your rate? I get that question all the time from people. You want to go with a reputable exchange company.
Sure.
How do you compare with some of the others out there?
Yeah, what's cool is that we just work off hugs, so that's really awesome. There's no fee involved. No, I'm just kidding. That's weird. So yeah, it's just under $1,000. That covers the sale and one purchase. Reverse exchanges, build to suits, where like there's construction involved and we're cutting draws to contractors. That could definitely be 5,000, 6,000, way up depending on what they're doing. But yeah, for most exchanges, they're under $1,000.
So other 1031 exchange companies, do they structure their fees differently based on a percentage or?
So some of them do. Yes, some of them do. Yeah, so again, 1031s are unregulated. So some of them may not make money in fees, but they may invest your funds to make up for that money. Like they may charge you, $500 and, say, oh yeah, we'll hold your funds safely and securely. And, they're putting it in Bitcoin or something and hoping the market goes up. I mean, everyone's got different reasonings and fees are all over the board. We're definitely on the lower end, but we're a large, efficient company. So it makes me wonder if anyone could beat us on price, what they're doing with the money. But again, it's unregulated. So it's ultimately, buyer beware. Clients definitely need to do their due diligence.
Okay, so really to get started on something, let's say I had an investor that was looking to do a 1031 exchange, it would just be contacting you, your contact information, signing a contract, establishing an account. Is that how they go about doing that?
Yep, absolutely. So ideally they'd set it up, shortly after they get under contract. And at that point, we'll reach out to title and escrow. We'll get docs. We'll send them an exchange agreement. The client's an exchange agreement to DocuSign. They let us know when they find property and we wire money out for it. So yeah, so the clients should almost forget that the 1031 is there. Their job is relatively minimal. They just need to find new property. We'll do all the paperwork and everything. So it's super, super simple for clients. And we'll make sure that nothing falls through the cracks. And if we need signatures or need anything, we'll definitely let them know.
So really, as real estate brokers, Kyle, we just need to get the contact made with you, 1031, and then help them find another property to replace within 45 days.
100%. Yep. Just make the introduction, then that's it. And then it's really just, help them find new property as soon as possible.
Okay. I think Patty had a
question. Hey, Kyle. I was curious, are there any plan Bs if they're really up against the 45-day window and they just can't lock into something? Is there a plan B that you would usually suggest for people?
Well, so DSTs are the backup that a lot of people use, but I'm not going to these are your clients, so I'm not just going to say, hey, you need to talk to someone about DSTs because, you know them better than anyone. And it's like, what their real estate goals are. So I'm not just going to do this, but it's definitely something where, if you have a client that's scrambling, it's probably not a bad idea to bring up. Plenty of agents and brokers do, but some don't want them to go into a DST because they won't get paid on it. So I'm not going to tell you what to do, and I'm not going to do that job for you. But, from an ethical standpoint, this definitely does help as a backup option.
Okay, that's great, because that was my question was, what is the DST an actual 1031 exchange event, or were you just bringing that up to say, consider this with an investor?
Yeah, good. So good point. So yeah, it's actually exchangeable. DSTs are exchangeable. So a lot of investors, they may have a DST where you just put in an indication of interest. It's not going to close for 90 days, but you just put in your indication of interest. I'm going to buy 1 million of this DST, and then it's held there for you. So you don't have to worry about closing and finding other property. So at a minimum, they can be great backups as well. But I just bring it up from a marketing standpoint too, because there's so many baby boomers that want to get out of rentals. They just don't know they have this option. So for those of you that go after listings, this is the best way to go after listings, especially in this market, especially right now.
So Kyle, if they exchange into a DST and they have to get out of the DST, do they have to hold it again for 2 years before they can get out of the DST?
Good question. So DSTs technically have maturities. So you may have a DST that states in the prospectus or wherever, we intend to sell this property June 1st, 2026. And so that approximately around that date is when they're going to sell. They're not liquid. So yeah, if you needed to get out, you need to find the DST sponsor, someone that would, essentially pay on the secondary market for your allocation, which could definitely come at a discount. It would be taxable. So these are definitely sold as non-liquid investments. I mean, generally physical real estate isn't liquid, but these truly aren't liquid. So yeah, you'd have to wait for another 5 years or however long the DST was going to be owned for before you could exchange into other fee simple property or another DST for that example.
Got it. So Kyle, if we were recommending someone to go into the 1031 exchange, I had a client who wanted to sell, interested in exchanging, would the 45-day period, would it make sense to start it either when we identify the property, say early on, or let's say if we don't have one yet, they're still looking, but they know they want to exchange. Would it make sense to start it like just a week before closing their property or something?
Well, so the 45-day clock automatically starts when you close escrow and when it records.
Okay,
so when they're first exchanging out. Okay, got it.
Yep.
Once you go under contract, when I've worked with 1031s, the moment I go under contract, then I'm on the hunt because you need more time, especially in today's market.
Yeah,
absolutely.
Absolutely right. That's been my experience. Okay, I wanted to say regarding DSTs, it's my understanding that when you get into a DST, whatever entity you enter into gives the time frame of holdership, and they're varied from DST.
Yep, absolutely. I mean, some DSTs are 3 years long, some are 9 or 10 years long. I think the average is about 5 to 7 years, but yeah, it varies per DST. I mean, the underlying properties vary, time frame, everything varies between DSTs. So yeah, a DST with self-storage units is probably going to look different than a DST that's just one big Amazon warehouse. For maturity, cap rate, everything, quality, risk, everything like that. So yeah, each one definitely varies.
So you have to be careful and choose the DST, hopefully, that fits your particular guide.
Yeah, absolutely. Yeah, we can never recommend DSTs. I will never recommend a DST to a client. I mean, it's nothing that we do specifically. But yeah, they definitely need to work with an investment advisor and go over risk, because you can never say anything is guaranteed when it comes to securities. Like even if it's an Amazon warehouse where that lease is even ahead of bondholders, it's like, yeah, that's essentially going to be money good, in our conversation, but you would never even guarantee that to a client. Even if it's Amazon, yeah, is Amazon going to be around in 4 or 5 years and be able to pay their debts? Well, yeah, of course, but we can't guarantee it, So we never make guarantees, and we never offer, specific examples to clients. We always refer them to talk to an investment advisor.
Right, that makes perfect sense. Okay, I did have a question.
Sure.
I understand that the guidelines have recently, maybe not so recently, but have changed over guidelines of, say, 10 years ago for people who have turned their properties into rental properties. They fulfilled 2 years of rents. Now they want to move in, but they cannot sell those properties without paying capital gains because they now have to live there for an additional 5 years.
So yeah, so we're going to end up down the rabbit hole on this. I'll just say this, and if you have specific questions, give me a call or shoot me an email, because this will literally take an hour to explain. But yeah, so if you convert to a primary residence, you have to own it for 5 years and live there at least 2 of the years. So then you break it down between what the IRS calls qualified and non-qualified years to get a prorated share of the 121 exclusion, the 250 or 500,000. That's kind of the 40,000 foot view. But what I would say is, just to keep it as simple as possible, yes, if your clients exchange into something, convert to their primary residence, and they own it for 5 years, they could at least get a portion of their capital gains reduced. Not all of it, but they would at least get some of it reduced.
Okay. I think my question is that they have already owned the property. They've had it rented out for 2 or more years, and they want to move in. So it's just straightforward, I think. Can they avoid capital gains by living there X number of years on the premises themselves?
Like if they sold it down the road?
Yes, down the road.
Yeah, so they run into like, again, like qualified versus non-qualified years. Years they lived in it versus years they rented it out. And they would get like a prorated percentage of the primary residence exclusion. So this is definitely, and we don't even know what that will look like. And like, if it'll even be around in, 5 years or 10 years. As of right now, though, it would be basically a divisible number of prorated versus non-prorated years.
Okay, thank you.
Yep. That's literally the most complicated question I will ever get on 1031s. It's seriously, it's a good question. It gets super, super complicated because then it turns into like estate planning. And, once you start figuring out prorated years and percentages, it's like, it's hard to understand even for any of us and even for CPAs. So it's a very, very good question. It's just something that clients will definitely want to confer with their CPA on and plan that out long in advance.
Any other questions? We're getting close to the 1 hour mark, but we don't want to miss some questions. If you have some good ones, I'm sure if you do, you can reach out to Kyle at a later point. He did give us his contact information. Are these slides that will be available to us?
Yeah, so we don't want them sent out. But yeah, just for you guys, they're not definitely to share with clients or anyone. But yeah, just if you guys want, I can send a PDF over to you. And
That sounds great.
Yep.
Yeah, perfect.
Yep.
Anybody else? I got a ton of nuggets out of this one, and one of them being that you need to pick a reputable, somebody that's backed with some money so that you aren't, referring someone that could risk your client's investment. Yep. So that was a great piece of information. So really appreciate that, Kyle.
Awesome. Very cool. Well, good. I guess this wraps it up, but yeah, I'll send the slides over, a PDF of the slides later. And if you guys have any questions or you want to expand further or just didn't want to ask, definitely feel free to give me a call or shoot me an email and we'll walk through everything.
Wonderful. Thank you so much for your time.